In this week's video, we'll review the charts of 19 different ETFs to help us answer the question, does asset class behavior confirm or contradict bullish charts? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. 455 calendar days ago, or back in August of 2016, we covered a relatively rare signal using weekly S&P 500 charts that told us to be open to bullish outcomes before and after the U.S. election. 252 calendar days ago, the title of our weekly video was Rare and Rapid Shift in This Stock Signal. The hard data covered in that video also told us to be open to much better than expected outcomes. And 7 calendar days ago, we covered a rare signal or shift that had only occurred 2 times in the last 60 years. Many of the signals that we've covered over the past year or two have told us to be open to better than expected outcomes for several years as one possibility. If that's the case, and if that turns out to be true, then when we examine asset class behavior, we should pretty much know what those charts are going to look like before we review them. For example, if we look at this chart of the triple Qs, or a technology ETF, relative to TLT, or long-term treasury bonds, so we're looking at a ratio of stocks to bonds. This is a daily chart. We've removed volatile price so we can focus in on the longer-term trends. The red line is the 200-day simple moving average for the ratio QQQ TLT. In simple terms, the left side of this chart is what a bullish trend looks like. This is a shift over to a bearish trend, and this is the type of look that we want to avoid. And since we know the CCM market model relies on the weight of the evidence, for us to be more confident in these bullish signals that we've covered, we wouldn't expect the present day QQQ TLT ratio. We wouldn't expect this chart to look anything like this. This is a shift from a bullish trend to a bearish trend. If we fast forward to the present day, we can see the chart looks like exactly what we would expect based on the bullish videos that we've produced over the last 12 to 18 months. This is a constructive look. This is a downtrend flipping and morphing into a bullish uptrend as of November 16th, 2017. Similar situation. Now we're looking at IWF, our large cap growth stocks, relative to intermediate term treasury bonds, or IEF, in the ETF world. This is the look that we want to avoid. We would expect the present day chart to look nothing like this. And we would expect it to look exactly like it does as of November 16th, 2017. This looks like indecisiveness, and this looks like the early stages of a new long-term bullish trend, as evidenced by the slope of the simple 200-day moving average for the ratio. This is exactly what we would expect home builders relative to the VIX to look like when animal spirits sprint for the nearest exit. This is what fear looks like, 2007, 2008. This is what confidence looks like, 2016, 2017. If you're running a stock mutual fund, you might have to stay fully invested in stocks all the time. If you're running a pension fund, your mandate might be to stay fully invested in stocks all the time, at least with a portion of your assets. Therefore, The only way they can get defensive is to move to defensive-oriented stocks. And this is exactly what we would expect VGT technology relative to XLP defensive consumer staples to look like during the transition to a long-term downtrend. And this, in the present day, is exactly what we would expect the chart to look like when animal spirits are picking up, as they have done since 2016, and especially most notable since roughly October or November of 2016. The slope of this line says long-term and sustainable bullish trend. When we say sustainable, we're speaking to probabilities. As always, we'll take it day by day. If you thought financial assets were wildly overvalued and Armageddon was right around the corner, you might decide to sell stocks and buy gold. And as we would expect, the trend for SPY, S&P 500, relative to GLD gold was already clearly bearish before the S&P 500 peaked in late 2007. How does the exact same confidence versus fear ratio look in November 2017? Does it confirm or contradict the previous videos? The answer is simple. It confirms. This is fear flipping over to confidence. This is a little bit of indecisiveness. And now the 200-day moving average has printed a new high above the consolidation. We can almost think of this as an animal spirits graph. Animal spirits tanked in late 2007 and early in 2008. Look at the slope of this line here. This is screaming something's wrong. And the slope of this line here aligns with all of the bullish charts that we've covered over the past 455 calendar days. The hard evidence that we've covered over the past 455 calendar days. How about industrial stocks relative to a diversified basket of bonds, or AGG? This is your fear roller coaster here, and this is a confident climb here in late 2016 and into November of 2017. If we thought major bubbles were about to pop, we might consider buying the stocks of gold mining companies. This is VTI, the Vanguard Total Stock Market ETF relative to gold miners. You can see the trend rolled over against stocks and in favor of gold mining stocks as fear increased in late 2007. Notice the fear-based trend goes from the upper left to the lower right. The confidence-based trend goes from the lower left to the upper right. This doesn't look anything like this. These are the type of trends that we want to invest in. Lower left-hand corner to upper right-hand corner. The slope of this line for the ratio of internet stocks, FDN, relative to the Japanese yen, or FXY. We can see this, measure it, put it in a model in Q1 of 2008, before really bad things happened in this area here. Upper left-hand corner to lower right-hand corner. Lower left-hand corner to upper right-hand corner. This looks exactly as we would expect it to look in the present day, and this looks exactly as we would expect it to look in early 2008. If you don't have a Swiss bank account, you can buy FXF, or the Swiss franc ETF. S&P 500 relative to the Swiss franc, the trend rolled over. We can see this here before really bad things happen here. How does the exact same ratio look today? As we might expect, the answer as of November 16th, 2017 is much, much lower left-hand corner to upper right-hand corner better. So now we have our rare signals, evidence of rare and rapid shifts in momentum, including the very long-term nimble barge look that we covered 7 days ago, and aligning with the concept that we want to make confident decisions based on the weight of the evidence. The answer to this week's question is very, very simple. We track all of this and convert it into a usable and actionable format in a reasonable amount of time. The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.